what I'd like to do to start off with is, again, we haven't spoken since this summer when oil prices were over $110 a barrel. They've now dipped obviously below 60. Can you give us some insight on two things, and we'll take this in sequence. One, the fundamentals of the market in terms of that price slide, which has been extraordinary, and two, the Saudi response. And I guess in this case we can safely say that the Saudi response is synonymous, at least operationally, with the OPEC response. Obviously Venezuela and Iran and other countries would approach it differently, but as a result of Saudi Arabia's approach to this price slide, OPEC responded in a certain way. Can you tell us the fundamentals of the price slide and then Saudi Arabia's response?
Well, the policy is basically to maintain market share, and the issue here is that for Saudi Arabia, as well as others, especially in the Gulf oil producers, it's important to maintain market share given that the global oil market has changed. And there are two possibilities for Saudi Arabia. One is to lose market share by reducing its position, and the other is to maintain market share, because the oil market has changed since we have new producers of oil and non-conventional as well as conventional oil producers. Nigeria, as well as Angola, as well as others around the world, are looking to tap into these markets. So for Saudi Arabia, they looked around and they took a very bold decision that they have to maintain market share at any cost, even if oil drops. And the question is, for how long can you sustain this? And of course, the answer is for countries such as Saudi Arabia, as well as the UAE, Kuwait, they can sustain it for quite some time. Because if they do decide that market share is not an important factor to control, then eventually they will lose market share to these other producers. And hence, that could very well ostensibly push prices, oil prices, much more radically below levels that we haven't seen. Also, I don't think that anyone expected that oil prices will plunge by such an amount in a short period of time. So I think that the anticipated call was maintain market share, and then if we see a price decline, we'll sustain it. The most recent comments from the oil minister, the Saudi oil minister, was that at 20 or 40, Saudi Arabia will not take a decision to lose its market share. And Saudi Arabia is in a very comfortable position to do it over the short to medium term. Of course, over the long term, I don't think anybody will be able to sustain such a policy, not Saudi Arabia, for sure, as well as others. So I think over the short term to medium term, the expectation is maintain market share and just do that rather than the reverse, which is lose market share and start reducing oil output, because this is exactly what they did in the 1980s. They reduced radically in the mid-1980s onwards oil output, and then they started losing market share. Oil prices went from 35 to 10, and that didn't help Saudi Arabia, and it took quite some time for Saudi Arabia to recover in terms of its market share. So I think that's important. Now, a lot of people have asked the question, is Saudi Arabia important in the global oil market sphere? You know, do they play this role of the central bank of oil? And I would say yes, indeed, they do continue to play that role. Saudi Arabia is really the only country that has this capacity. And you might say, well, today we don't need it because we have ample capacity. Numbers have come out from the US where we see inventories rising. This has driven Brent prices further down, and WTI is also going down. But again, this is a short-term effect. I do believe, if you ask me where is oil price going to be a year from now, I would say that right now the downside to oil prices is exaggerated. a year from now, we will see oil prices around the low 70s. And low 70s is very good for Saudi Arabia as well as other GCC oil-producing countries. I would be very happy with oil at 70. But right now, I think there is a lot of exaggeration. There is a lot of panic. It reminds me a little bit of the 2008 situation where oil prices were rising all of a sudden because there was this country, China and India, and everything that needed to be explained about this spike in oil prices was justified due to the demand in China and India. And today we're exaggerated on the downside, and we're at the opposite side of the spectrum. So we talk about China slowing down, India growing but not so fast as before, Europe having problems, Japan the same, and then the only ones that are growing is really the US, North America to be precise. But yet again, I would say that the global economy requires a lot of oil, and 2015, 2016, we will see greater demand. So I do see that oil will gradually rise to this 70, 80 sphere in the next 2 years. I don't really expect oil to go back to $120 a barrel anytime soon, certainly not over the next 2 years. And that's because we're not back to these catalysts for enormous global growth. But emerging markets, where we see 55% of GDP coming from, is going to return into more solid growth. Latin America will start growing faster, the same with Asia, and the same with Africa. So all of these growth engines require oil, particularly Asia. So I'm not so pessimistic as a lot of people would try to explain the situation we're in. And of course, a lot of analysts do follow the consensus bias. They would like to go with the tribe and the herd mentality. And so everybody now quotes for oil at 50, oil at 40. It's like the dollar. You know, the dollar all of a sudden is getting stronger. Now everybody says that the dollar is going to get even stronger. Well, if we keep on saying it, eventually the dollar by default is going to get stronger. At some point, it's going to get weaker. And then everybody's going to be saying, well, it's going to get weaker. And so this is a self-fulfilling prophecy. So I do believe that the fundamentals are there, and they will become more accentuated in 2015, 2016. But, you know, Saudi Arabia is found in a very comfortable situation because, again, they have enormous fiscal buffers. And during the very nice days, they saved a lot of money. And the more challenging days, they're spending a lot of money. So this is exactly at the core of this counter-cyclical fiscal policy, which very much got represented in 2008 and 2009 when the financial crisis was hitting everybody, and oil dipped for a while at $33. So Saudi Arabia came up and decided to spend a lot of money so that it avoids a huge recession. In fact, out of the G20 countries, there were only 3 in 2009 that didn't experience a negative real GDP number, and Saudi Arabia grew by 1.8% in real terms, positive real GDP growth. So again, they're doing the same thing today.